the best of Money Matters. Market View on Money FM 89.3.
Hi, I'm Willie Keng. You are listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch. Now, Singapore stocks opened lower this morning as Asian stocks struggled on Wednesday's market open. By midday, shares of Singapore's three local banks traded mixed. DBS fell 0.5%, OCBC traded flat, and UOB climbed 0.2%. With that, the benchmark Straits Times Index has closed 1% higher at 3,662 points. Now, US tariff tensions and the back and forth negotiations amongst partner countries have sent markets in a whirlwind for 2025. With the worry of lower business confidence and a pullback in consumer spending, would this lead to a potential recession? And how has tariffs hit first quarter US corporate earnings? Next, we turn to shares of the Magnificent Seven, including Apple, Microsoft, and Alphabet, which have seen solid gains in 2024. However, performance of these tech giants have been disappointing through 2025 so far. What should investors make of these situations? With that, let's unpack all of these developments with Cedric Ho, founder and portfolio manager at MAD Partnership. Welcome to the show, Cedric.
Hey, Willie. Happy to be here.
Great. Let's dive in straight into the markets here, Cedric. Now, I just want to get into the US markets. How have the US markets fared so far for the weekend? What is driving markets?
I think one can only describe the market as being unsure at this point. 5 major US banks have reported earnings in the past few days. The themes I'm hearing are analysts revising earnings estimates down by 5% on average, and raising the probability of a recession. Words used during these earnings calls are cautious, unpredictable, consumers bracing for higher costs. And I guess this is reflected in the flat market over the past 2 trading days, where there's less fear than there was last week, but generally still a pretty uncertain market.
Now, just following up from US markets here, what do you think are your views on how drawn out the tariffs are? I mean, we see some reprieve in Trump's 90-day tariff, and then, of course, you have some back and forth negotiations. So what are the chances, do you think, of a potential recession?
So as far as triggers for the bear markets go, I think this is one of the more interesting ones in recent memory. It's interesting in the sense that, for me, the trigger is not a natural economic event. What do I mean by that? If you think about the 2022 market decline, that was caused by runaway high inflation. So a natural economic trigger. 2008, the Great Recession, that was sparked by a crisis in the subprime loan segment.
Right.
Again, a natural economic trigger. This time round, the trigger is rather artificial in the sense that it was caused by the actions of one man. And so the way I would analyze this bear market is not using economic theory as a starting point. I would use 2 other disciplines of study to analyze this. Game theory and human psychology. In game theory, this is a classic game of hawk and dove. There are 2 individuals in the game. Each individual can either be a hawk, an aggressor, or a dove, peace-loving. The US has clearly taken the role of the aggressive hawk. And as of last week, it wasn't really that clear which role the other countries would take. With the passage of a week, we now know that most countries, through their actions, have indicated that they will play the role of the peace-loving dove. As a result, the US has also lowered its aggression in the form of exemptions and a 90-day pause for negotiations, like you just mentioned. Therefore, the chance of greater conflict and economic turmoil with these countries going forward is much, much lower, in my opinion. China, on the other hand, has decided to take the role of the aggressive hawk. As a result, the conflict between the 2 hawks continues. While as investors, we hope that this conflict will resolve soon, I'm actually not overly worried if it doesn't. US-China trade conflicts are not new. And compared to what we've seen in the past 2 weeks, it is unlikely to create larger shocks to the stock market.
Right.
Now, the second discipline of study that's relevant here, in my opinion, is human psychology, and specifically the psychology of the aggressive hawk, Donald Trump. He is facing immense pressure at home in America for his actions. American business leaders, from Elon Musk to small business associations, have called on him to stop these actions because their businesses are suffering. The wider American public is also in panic mode, as can be seen from the frantic days of selling in the stock market. No one at home is happy. When he called a 90-day pause on tariffs, he had already alluded to one reason was because people were getting, in his words, yippee-yappy. So while Trump is a controversial person, I don't believe he can continue withstanding that kind of pressure if the markets continue their free fall and the U.S. eventually goes into a recession because of his actions.
Right.
I believe the easier option for him is to backtrack in a way that will save him face. So if you see things as I do, then one natural conclusion is that this shock to the market has a low probability of getting worse. And if these trade deals end up helping the U.S. address its trade deficits or ultimately help its budget deficit, that can only be a good thing for U.S. investors.
I really like your analogy on the hawk and the peace-loving dove. Now, if we turn to our attention to the US markets, specifically on the Magnificent Seven here, I mean, shares of the Mag 7, including Apple, Microsoft, Alphabet, they have seen solid gains last year. But performance of these tech giants so far has been kind of dismal through 2025. So, Cedric, what are your thoughts on the Mag 7 share performance? Are they sort of like the peace-loving dove you have mentioned earlier, and are they also impacted by the tariffs?
Yeah, well, at the turn of the year, going into 2025, I actually wrote to my investors that I felt the Magnificent Seven were getting rather overvalued as a group. As a result, we exited our M7 positions and moved into more mid-cap companies. Now, I didn't quite expect that view to play out so soon in Q1, where share prices dropped across all the M7 while our mid-cap stocks held up pretty well. Currently, I would say the M7 are slightly cheap, but probably not super cheap after the huge run-up we've seen in the past 2 years. In terms of the direct impact of tariffs, I expect Tesla to be hit hard because they're still exporting Model S and Model X into the Chinese market from California. Amazon will be affected somewhat as there are many sellers on their e-commerce platform who source products from China and other Southeast Asian countries. While not tariff-related, NVIDIA yesterday announced greater export controls imposed by the U.S. government that will cost it an extra $5.5 billion in revenue. So as for whether share price will continue to rise for the Magnificent Seven, who really knows for sure, right? All I can say is many of the M7 have businesses that are strong fundamentally. In the past 2 years, the M7 have seen really strong share price appreciation, and I believe the chance for another strong year is lower, especially since they are not super cheap at this stage. My view is that they should continue to do decently well as long as the U.S. economy chugs along.
Speaking of decently well here, I hear that you actually moved in terms of portfolio allocation, moving into some of the mid-cap stocks. I just want to get your game plan for the recent market declines. What do you think investors should do here in this current market conditions?
Okay, well, I feel, first of all, your mental state is important. If you're panicking, there's a higher chance you will end up making wrong decisions in the stock market. So for investors who find the headlines too much, I would suggest taking a break from the news and not checking your portfolio for the next 3 to 6 months. In terms of strategy, there are 3 truths to keep in mind. First, the market will decline from time to time. Second, no one can predict when the market will bottom. Third, over the long run, especially in the US, the market tends to go up. Now, with these truths in mind, we can then implement a sound strategy to take advantage of market declines if you have capital to deploy. I would divide the capital into 6 tranches. You might want to start deploying the first tranche when the market has declined 15%. With every subsequent 5% decline, you allocate another tranche. You continue doing this for the 6 tranches. While you will never be able to allocate all your capital right at the bottom, a good chunk of your capital will be used to buy stocks at very cheap prices. And this will set you up very nicely for the subsequent recovery. Now, having said that, I know it's easy to have a plan on paper, but when the market is in free fall, it's extremely hard to execute the plan. What I would suggest for those who have this issue is to start small. Perhaps start very small. So let me use some numbers for illustration. Say you have a $100,000 portfolio. Start buying the dip with $1,000 or just 1% of the portfolio. This way, even if the market does continue declining, the paper loss from that $1,000 will not be super painful. If it hurts, stop. If it doesn't, when the market declines further, allocate another $500 to $1,000. Starting small, for me, is a good way to train yourself to act, in spite of what your emotions may be telling you. Now, there was a second part to your question, which is what I'm doing for my own portfolios that I manage. So on the way up at the start of the year, I actually lightened some of my positions because I thought they were getting too expensive. The portfolios I managed were in about 25% cash entering the bear market. I started buying again when many stocks dropped 30% and continued buying as they continued dropping. I still have another 1 to 2 rounds of bullets to fire. If I'm done allocating the capital and the market continues slumping, my next move would be to sell lower conviction positions and reallocate capital not just to higher conviction ones, but also to those I believe will recover faster during the upturn.
Right.
So, for example, if I'm in Microsoft, I might lighten it and add more to an undervalued mid-cap stock, because I think the mid-cap stock has a higher chance to double than a mega-cap company like Microsoft. Of course, no one will know exactly how it will play out, but investing is basically a game of probabilities and judgment. Over time, as a portfolio manager, I hope to make more right calls than wrong ones.
Just one more question before we let you go, Cedric. What stocks are on your radar for the week?
Okay, well, many of my companies are not really reporting until about 2 to 3 weeks later, so nothing really on my radar this week. But what I will say is for this earnings season, there are perhaps 2 companies I'm more interested in. The first one is Grab. It's a company that is unlikely to be affected much by tariffs. Grab has gone through years of high revenue growth, but ultimately unprofitable growth, which is why you see it being punished by the market. I believe it could be at an inflection point when it comes to profitability. Management has said that profitability and reasonably high revenue growth is their focus for 2025. I'll be looking for them to start delivering in Q1. Another company is Amazon. Amazon is at a stage where top-line growth is slowing, but margins from AWS are improving. The net result is higher profitability over the next few years. With the impact of tariffs, the e-commerce side might be negatively affected to the extent it negates the good work on the AWS side. So I'll be interested to see how this plays out in Q1 and hear what management has to say during the Q1 call.
We have been speaking with Cedric Ho, founder and portfolio manager at Mad Partnership. Thank you so much for your insights, Cedric.
Thanks a lot, Willie.
Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.